when you look at these instruments, we can classify into debt instrument and equity instrument. What is a debt instrument? The debt instrument, when you are buying, for example, bond, debenture, certificate of deposit, you are giving a certain sum of money to a borrower, let's say HDFC Bank or HDFC Limited, that is Housing Development Finance Corporation, is giving a bond or a debenture 7%. That means you will get a 7% annually interest, plus after the specified period, let's say 2 years or 3 years, you will get back the money that is invested. For example, you have invested 1 lakh rupees. Every year you will get 7,000 as interest. And at the end of 3 years, you get back your 1 lakh also. This is the advantage. One way is you are getting a regular interest, and there is a certain amount of capital safety to a great extent. That means at the end of the tenure, you get back your money. That is the advantage. Now, you can either participate directly or indirectly. Now, why do I say it directly and indirectly? One way of participating, you go and buy the bonds. Let's say RBI bonds, ICICI Bank bonds, HDFC bonds, infrastructural bonds. There are various types of bonds are available. Debentures are available by the company in the stock market, which gives you certain amount of interest. Interest is between, let's say, 6% to 8%. When you go to private sector bonds, you may get around 12 to 14%. Private sector bonds means the companies which are private in nature and the risk level is higher. For example, Muthoot Finance is giving you accepting a deposit, corporate deposit at the rate of 12%. But there is a risk of it, whether the Muthoot Finance will pay back after 3 years your money, that is a risk aspect. Whereas when you take corporate bonds, higher value bonds, the interest rate is less, let's say 7%. HDFC is offering 7% interest bonds are offering, which means you will get back, the rating is higher, because of which you will get back the money, the security is higher. So that is a difference in debenture. These debentures, now when you value, there are debenture valuation techniques are there. One of them is looking at the general interest rate. Now you have bought a debenture worth of 1 lakh, which gives you 7% interest. Now next 3 years, you are going to get 7%, that is 7,000 rupees every year for the next 3 years. Now the interest rate in this country is increasing. Now the repo rate, bank rate, all these are increasing, because of which the companies are issuing at a higher rate. Now another company, ICICI, issued a debenture at 9% interest rate. When you go and take that one, this HDFC value is lesser, because your next 3 years, you are already promised that you will keep it for 3 years and you will get only 7,000. Whereas ICICI is giving you 9%. That means the HDFC valuation is lesser. That is, if the interest rate increases in the market, your bond value reduces. If interest rate is reducing in the market, then bond value increases. For another example, now government has taken relaxed rule and interest rate is reduced, cut off. Now the new debentures are issued at 6%. That means your HDFC Bank, HDFC bond is higher valued than that of other bonds issued today. This is one of the aspects. Now you can also indirectly participate in this particular game of buying and selling bonds. How? Through mutual fund. These are called debt mutual funds. I have already shown one of the example here, corporate bond, where the interest rate, you will not directly giving money to the borrower. Instead, through mutual funds, you are giving. These mutual fund, debt instrument mutual funds, debt schemes are investing their money into bonds, government securities, or short-term and long-term debt instrument. They make advantage of buying and selling depends upon the market conditions and generate a return for the mutual fund holders. So either you can directly give, so there is a risk involved, or you can give indirectly through mutual fund. Risk is comparatively lesser, but return also comparatively lesser because there will be cost associated with the management. I hope you have understood what is a debt instrument. Debt instrument, as a investor, you are giving your money to a borrower who I know mostly it is a corporate, either in the form of bond or debenture or certificate of deposit. Other things are there which we need not worry about it. Other money market instruments are there, and by which the borrower gives you a fixed rate of interest over a period of agreed period, let's say 3 years, 5 years. And at the end of that particular period, you get back your money. Now you can participate it in directly buying it from the stock market, debt instruments, or indirectly by buying mutual funds, debt mutual funds. These are the two ways you can look at it.